Hello guys and welcome back to the channel. Today, we're diving deep into the latest Bitcoin and Ethereum market cycles, breaking down the patterns, the risks, and the big institutional moves shaping the future of crypto. If you want to understand where prices could be heading in the next year and beyond, stick around. This video will give you the insights you need to navigate the market with confidence. Bitcoin is standing on the edge of history once again. We are just a hair's breadth away from a new all-time high. The last peak was just over $123,000, and right now we're brushing against 122. That alone is enough to get traders buzzing, but the real story isn't just the number on the screen. It's the pattern beneath it, a rhythm, one that has repeated in nearly every Bitcoin cycle after a halving. And if that rhythm plays out again, the next few months could be nothing short of explosive. Let's rewind the clock. Post-halving years like 2013, 2017 and 2021 followed an almost identical sequence. July brought strong gains. August went even stronger. September brought a pullback. And then October became the launchpad to the cycle's top. It's not just coincidence. It's been almost clockwork. And here's the kicker. During each of those cycles, September didn't mark the end of the bull run. It was the start of the final act. At the center of that pattern is the bull market support band, a zone of key moving averages that often serves as the market's launch platform. In 2013, 2017, and 2021, Bitcoin rallied into late August, dipped in September just enough to touch the band, and then blasted off to the cycle's peak. Right now, that support band sits around $105,000 to $107,000, and it's rising. By mid-September, it could be between $110,000 and $115,000. Think of it as an elevator slowly rising, and the market tends to step in right when it reaches the perfect floor. From the market bottom, the last cycle topped on day 159, the one before that on day 167. Today, we're only on day 101. That means if history rhymes again, we could have weeks, maybe months before the final high. But once momentum kicks in, the top can arrive faster than most expect. So what does this mean for altcoins? History suggests something counterintuitive. They can lose ground both when Bitcoin falls and when Bitcoin rises sharply. When Bitcoin drops, risk appetite across the market drops with it. When Bitcoin rallies hard, traders often rotate their capital back into BTC to ride the strongest wave, leaving altcoins behind. 2017 proved the point. In October, when Bitcoin dipped, altcoins fell. Then, when Bitcoin rallied to its peak, many altcoins kept falling in Bitcoin terms. Looking ahead, many alt-BTC pairs could peak between August 22nd and 24th, give or take a few days. Ethereum might keep outperforming Bitcoin until then, but if the pattern holds, September will likely pull liquidity back toward BTC. Now let's talk about Ethereum, the clear outperformer in recent weeks. ETH has been leaving Bitcoin, Solana, and most other major coins in the dust. The fuel behind that run? Wall Street. Spot Ethereum ETFs have been absorbing ETH at a remarkable pace. If you take the last 2 weeks and annualize that rate, these ETFs are soaking up the equivalent of 4.2% of Ethereum's total supply each year. For comparison, Bitcoin ETFs are taking in about 3.7% annually, but they already hold 6.5% of all Bitcoin in existence. Ethereum ETFs hold just 4.5%, which leaves more room to grow. ETH's share of the total crypto market cap, its dominance, hit a major low in April, matching levels last seen in 2019. Historically, that has been an excellent buying zone. Since then, dominance has climbed to around 14%. That's not overheated yet, but it's warming up. With ETF inflows starting to cool, Ethereum could soon face resistance, especially against faster-moving competitors like Solana. Bull markets in crypto tend to follow the same rotation. Bitcoin rallies first, then Ethereum takes over, then Solana and similar high-beta assets run. Finally, the smallest altcoins and meme coins explode. We are firmly in the Ethereum phase now, but without another major catalyst, like more ETF approvals, the rotation could stall before Solana gets its moment. So far, that's the bullish story. But even the strongest ship sails through waters filled with hazards. Bitcoin's journey to new highs could be slowed or even stopped by any number of risks. Imagine 10 icebergs in its path, a world that suddenly behaves, where governments stop overspending and printing money, weakening Bitcoin's hedge against fiat collapse narrative. Fear that lingers, persistent pessimism draining market energy. A quiet network, falling active addresses hinting at declining use. Whale sell pressure, large holders capping rallies before they can break free. The museum effect, Bitcoin becoming more a collectible than a currency. ETF inflows drying up, without fresh demand, momentum fades. Shiny distractions, AI stocks, renewable energy, or meme coin manias stealing attention and capital. A black swan in the code, a flaw, a hack, or quantum tech threatening security. Political shifts, regulation, taxes, or central bank digital currencies limiting adoption. Liquidity drains from altcoin manias, capital leaving BTC for speculative plays. Individually, none of these guarantees a bear market. But together, they form a web of risks that Bitcoin must navigate. Right now, the cycle is playing out much like the three before it. Bitcoin leads, Ethereum follows, altcoins trail. If August closes in the green, prepare for a September pullback into the bull market support band, which could set up Bitcoin's final, most powerful rally of the cycle. Until proven otherwise, the old playbook is still working, and the market for now is still dancing to the same old rhythm. The role of economic history and institutional forces. Looking back at economic history, one thing becomes clear. Large-scale financial trends often move in cycles of regulation, innovation, and institutional involvement. Markets aren't just random chaos, they're shaped by the players and rules on the field. Over the past decade, institutional investors have slowly but surely entered the crypto arena. What was once a niche market for tech enthusiasts and speculators is now becoming a staple for hedge funds, pension funds, and family offices. Easier regulations and clearer frameworks can accelerate this process by lowering the barriers to entry. When governments provide a stable legal environment, institutions gain confidence that their investments won't be snatched away by sudden bans or crackdowns. This wave of institutional money brings with it a powerful dynamic, capital that's larger, steadier, and more patient than retail traders. It can sustain price levels and fuel upward trends, especially when paired with products like ETFs that make buying seamless and compliant. In fact, history shows us that market surges often coincide with waves of institutional adoption. Think of the 1920s stock market boom, or the tech stock rally in the 1990s. Crypto seems to be following a similar path, with ETFs and institutional wallets growing rapidly, suggesting that we may be at the beginning of a larger bull market cycle driven by these forces. How market theories tie into crypto cycles. To make sense of these repeating patterns and the ebb and flow of market sentiment, many traders rely on frameworks like the Fibonacci sequence and Elliott wave theory, both popular in crypto circles. The Fibonacci sequence, rooted in mathematics and nature's design, shows up in markets as a series of key retracement levels, roughly 23.6%, 38.2%, 50%, 61.8%, and so on, where prices tend to pause, reverse, or accelerate. These levels often align with support and resistance zones, helping traders anticipate where the market might turn. Elliott wave theory builds on this by suggesting markets move in repeating 5-wave impulse patterns, followed by 3-wave corrections, a kind of natural rhythm of expansion and contraction. When these waves align with Fibonacci retracements, it creates a powerful tool for forecasting potential price targets and turning points. Applied to Bitcoin's history, these theories help explain the strong rallies in July and August, the pullbacks in September, and the final surges in October, a cycle that appears deeply rooted in both human psychology and market mechanics. While no theory is perfect or guarantees success, combining them with on-chain data, institutional flows, and macro trends can paint a more complete picture of what's ahead. Looking ahead, predictions for Bitcoin and Ethereum verse. So, what can we reasonably expect over the next year and beyond? Bitcoin's journey will likely remain volatile, but with an overall bullish trajectory. If the cycle continues as before, Bitcoin could break past its previous all-time highs sometime around mid-2026, driven by institutional inflows, ongoing tech upgrades like Lightning and Taproot, and increased real-world adoption. However, volatility will be part of the story. Expect steep corrections and sideways consolidations. But those dips might present opportunities rather than threats, especially if the broader macro environment remains supportive. On the regulatory front, more clarity and positive rulings, especially in major markets like the US and EU, could unlock fresh waves of capital, further fueling price growth. But watch out for surprises. Sudden crackdowns or regulatory uncertainty could cause short-term turbulence. Ethereum's future looks promising, but depends heavily on continued institutional demand and technological progress. Its transition to Layer 2 scaling solutions and roll-ups should make it more efficient and user-friendly, increasing its appeal for developers and investors alike. Wall Street's appetite for Ethereum ETFs and institutional holdings might slow as the first big wave passes, but sustained interest from DeFi, NFTs, and new applications could keep demand buoyant. Competition is a key risk. Platforms like Solana, Avalanche, and others are fighting for developer mindshare and liquidity. Ethereum must continue to innovate to maintain its dominance. For investors, that means carefully monitoring Ethereum dominance metrics and relative performance against competitors, rotating capital as opportunities emerge. Ultimately, the next few years will be a test of resilience and adaptability for both Bitcoin and Ethereum, two pillars of the crypto space navigating a rapidly evolving landscape. The story of crypto is one of cycles, human behavior, and innovation. Those who understand these forces and stay grounded in data and history will be best positioned for what comes next. Thanks for watching. If you found this breakdown helpful, don't forget to like and subscribe for more in-depth crypto analysis and market updates. Drop a comment below with your thoughts or questions. I'd love to hear what you think about Bitcoin and Ethereum's future. Until next time, stay smart and stay ahead.